Good to go? Let you take a sip. All right. What's going on, Matt?
Not much. It's been a great day with a lot of energy here.
Interesting venue and type of talks we're hearing.
I love it. It's been a really
we had the options panel a little bit earlier. We did.
Yes, lots of interesting insights there. Right. It's great to see
setting the stage for today, right?
Yeah,
or
absolutely,
Okay.
absolutely.
So, it's finally great to meet you. I mean, we talked maybe 6 months ago. It was a prep call, and we were talking about like trading strategies and all this kind of stuff.
Yeah.
So, but before we get into the thick of that stuff, do you want to maybe kick things off with a quick introduction? How'd you get involved in markets? Give us a taste of your career from the trading pits to the screens.
From the trading pits to the screens. I love it. So I took a rather circuitous route to finance. I started my life as a musician. As a young kid, I grew up in Houston and was always into music, and I started playing saxophone at a pretty young age. I slowly kind of realized that was something I wanted to do with my life, and so I ended up playing all through high school and then playing and going to college and getting a saxophone performance degree, which comes in handy, not very often, especially in finance, but it's what I love to do. And so after I graduated from college, I actually went and got a master's degree in saxophone performance, which also was equally not useful. But eventually what I ended up with was kind of falling backwards into trading by meeting someone who offered me a job trading on the CBOE. And I started there in 1997. I was a clerk for 6 months and then started trading equity options. Pretty quickly after that, I traded index options, and then I moved to London, where I kind of rebuilt a desk for a company called DRW, which is a Chicago options market making business, and I was there for 3 or 4 years. That was really a kind of fertile ground for me educationally. It taught me a lot about options, and then I moved back to the United States, started a business in the market making field again on the CBOE, on the floor of the CBOE, and we traded index options for the better part of about 10 years on that floor, and grew that business and then wound it down in 2015. Took a little bit of time off then, and now I was given an opportunity to be the principal of investor education at OCC. And what that means is that I teach people about the benefits and the risks of exchange traded options, which is kind of a perfect fit for me professionally. It kind of scratches the itch in a couple of different ways. It leverages my experience in the capital markets and allows me to, get up on stage every once in a while, not with my saxophone in my hand, but a microphone and talk about options, which is kind of a confluence of a couple of different things that I really enjoy. So that's where I am now.
Nice. What were some of the products that you traded back in the day?
Well, I started with single stock equities. So Xilinx, the Xilinx pit was the pit that I was in. It's a semiconductor. That was the SIBO pit that I started in, and then traded the OEX, which is like a bygone era product that not many people other than maybe JJ Kinahan, if he's in here, ever traded. That's the S&P 100. And then I traded S&P 500 options, VIX options, Boon Bobble shots, which are German's 2s, 5s, and 10s. In London for DRW, and then also some agricultural options along the way. It's been a little bit of a mixed bag for everything, but the best part about that is that the optionality piece of it, which is the part I find fascinating, kind of applies to every single asset class where options exist.
Thank you. What are some of the essential functions and responsibilities of the OCC in terms of ensuring the stability of our markets?
That is a good question. That is the reason why we show up to work every day at OCC. It's so the OCC is the largest centralized clearing facility of options in the world. We clear north of 40 million contracts a day. And if you do the math, there's 250 trading days in a year. You can do the quick math. That's north of 10 billion contracts cleared a year. Last year, we cleared 10.3 billion contracts. If you trade equity or index options in the United States market, somewhere along the line, that option is touched by OCC, whether it's in the clearing process, in the exercise and assignment process, the settlement process. The OCC is really the actual pipes behind what is happening in those capital markets in the option space that ensures that the market is orderly, efficient, and safe. They do that through a couple of different ways, but the real story ultimately is that the volume over the last 10 years has absolutely exploded, and OCC's been in business doing what they do for 50 years. This was our 50th year anniversary, and it's an incredible kind of story from beginning to end as far as what they do, but the important part about it is that it continues to function extremely well, even in the midst of environments where north of 10 billion contracts are going through those pipes. So that's what OCC does, essentially.
Gotcha. Do you think the value of the OCC is kind of underappreciated? It doesn't sound like many people talk about it.
Well, it's interesting. Yes, I do think that. Oftentimes there are situations like this where we have the opportunity to kind of raise the awareness of what's happening and what OCC does behind the scenes on a daily basis. It's not something that's terribly sexy from the outside in, right? I've been on both sides of the actual trade. I've been on the clearing side, which is where I'm now, and I've been on the market making side and the trading side. One side is definitely more exciting on a daily basis, but one side, the clearing side of it, is also extremely important relative to a market that is functioning healthily and continuing to do what it does on a daily basis.
Okay, gotcha. So this next question is, and you mentioned this 40 million number. I'm curious, 10, 15 years ago, what was that?
That's a good question. Many times when I'm talking about volume, I oftentimes reference 2008 because a lot of people have that as kind of a baseline in their mind for something crazy that happened, right? I mean, I was trading the SPX in 2008, standing in the pit. It was definitely the craziest thing professionally I had ever seen from a trading perspective, and I looked up at the tape at the end of the year, and it was like 4.3 billion contracts. So if you fast forward, we're talking about 2.5 times that number. And at that point in time, that was a crazy, crazy year. And it was something that no one had ever seen before in the capital markets, particularly in the United States. And so that gives, I like to use that as just a frame of reference to give people an idea of what it looks like now versus what it looked like then.
Yeah. How do we get here today? Is that structural? Is it the products that are listed?
Another good question. I think lots of people have espoused lots of opinions about this. I think if you look at the volume numbers over the course of the last 5 years, particularly, what you see is a gradual move up and then a huge leap in 2020 during the pandemic. We had obviously stimulus checks. We had everyone having frictionless access to zero-cost brokerage, and we had a lot of people that were stuck on their couches in their living rooms looking for something to do. That is obviously a confluence of events that points directly to what we're seeing and what we see on that graph in 2020 and 2021. The interesting part about it, I think, is that if you were to ask me whether or not those volume numbers would be something that would stay when you removed the actual external forces that were theoretically causing it, I would have told you 5 years ago there's no way that they would go away. And what we're actually seeing from a volume perspective is that those volume numbers are very sticky and that they're not going anywhere. And actually, this year, it looks as if the OCC is going to clear somewhere close to 11 billion contracts. And none of those things, none of those kind of exogenous events are still a part of this landscape, right? Other than, I mean, there's still zero-cost brokerage and things of that nature, but it's not something that came and went as, you know, and passed as the pandemic passed. What we have now is very sticky volume numbers, and we're seeing rotation into different products. So initially what you saw was in the meme stock craze, you saw a ton of single stock option volume happening. As that died down, what you saw was this kind of rotation into ETF volume, which people start, you would see numbers that said ETF volume in options is up 60% year over year as the meme stocks were starting to die down. And so what that says to me is that people are kind of waking up to the actual flexibility of options more generally, more broadly, and they're using them in the way that they, should theoretically be used, and using them in different asset classes as they start to align with what their goals are, right? And that's really what that's really what I do as a principle of investor education, right? It's what I try to actually get people to understand is the actual embedded optionality that exists in all of those contracts.
Got it. One thing we discussed a little bit earlier today was with Chris and Michael Green was just the who is participating in these products, right? It's not just institutions, it's not just retail, and vice versa. There's been kind of a narrative associated with some of these products like zero DT and it being speculative, but then at the end of the day, there's a lot of institutions that are trading it as well. Do you want to talk a little bit about kind of, the one thing that stuck out in that prep call when we had is, honestly, options give you that ability to get, express your opinion in a more granular way, right? And so do you want to share insight into how these products help investors, whether retail traders at home or institutions, can better express their opinions?
Yeah, that's something, and it's kind of intimately tied in today's marketplace with the conversation surrounding zero DT options. It's a conversation that continually happens on a day-to-day basis. It's something that I spend a decent amount of time talking about, and the reason why is because I'm trying to teach people that those options themselves are not necessarily something that anyone cooked up in a lab, right? They are options that exist, that have always existed in the same way that they exist, and a zero DTE option is just an option that's come to the end of its life cycle. It's on its last day of trading. That's all it is. The important part about it is that people understand two things. One is that they understand that the flexibility that exists, the granularity that those things provide, is really a recent development that did not exist 5 years ago or 3 years ago, right? Like the zero DTE space has been something that started in 2005 and then again in 2016 and then again in 2022. And so what you have is this curve of granularity that you're talking about that actually allows people to hedge very discrete risk events in a very granular way that they can hedge for a particular day, right? They can hedge for a particular day that doesn't fall necessarily on a standard expiration, which previously, when I was trading in 03, right, if I wanted to trade something that happened in between two expirations, I had to go find which one of those expirations would best meet my needs from a hedging perspective. Sometimes it was the one before the theoretical event. Sometimes it was the one afterward. Well, what I can do now, since these contracts exist, is I can go buy or sell the actual day's option that exists, right? That's a completely different thing that exists for the option market now that didn't exist 10 years ago. And that's really important. The second thing I think is really important, and this comes always from my perspective as an educator, is that people understand how the actual basics of those options work, which means how do options act when you remove time from the equation? What do they do theoretically when they only have 1 day left to expiration? Because that's really integral into understanding, once you are able to hedge those discrete risk events, it's really important to understand, now that I have this on, how does this thing work, right? Like what is my risk? What does my risk headline look like? And what happens if the underlying moves by 4 standard deviations, right? Like what does it do? And so I think that's an important part of this as well. It falls kind of at the feet of the investor, along with, it's the Spider-Man thing, with great power comes great responsibility. There's a little bit of that involved in it as well, right? Like if you're able to hedge any particular event, that's all well and good. What I encourage people to do is understand how the actual optionality works so that they can make better decisions in that case.
Got it. And you can see that in the term structure of vol, like where, the event centered around those events or whatever, and then
Absolutely, it'll look like this, right? Like
yeah, which
there's
is
the event, and on the other sides, people don't care about the ball on
a
the
little
other
bit of
side.
a departure from where
Absolutely.
it used to be.
Yeah.
But another thing, we talked a little bit about this earlier. A lot of the activity you're seeing isn't necessarily people punting these options and
Yeah.
so on. And so maybe they're going out there and they're selling, the 0DT or whatever it may be, or the very short-dated options. And by doing that, that's actually a very stabilizing trade within certain limits,
Yeah.
based on how the counterparty responds to it.
Absolutely. I think it's interesting, and there's been a couple of conversations about it that I think are really interesting. One of them is that if you were to design that marketplace from the ground up, and you had two sides, which is one side being the market makers and one side being the institutional or the retail investor, you would really want the sell side of those contracts to actually be with the market makers, because they're the ones who have the access to the 78 different ways to hedge their position, right? They're the ones with the strong hands as far as the market is concerned. I think you might want to reevaluate your thoughts about it if you start to see that actual flow flip to the other direction, right?
Yeah.
Like that would be an indication to me that maybe, okay, well, we should look at this from a different perspective than we currently do.
Yeah. Another thing we talk a lot about is like these products that already exist out there, ETFs, packaging everything together for you. But, and I believe at the OCC you kind of do this, is help educate investors that they can do it on their own. And here's the tools and the way you can do that, right?
Yeah, I mean, that's kind of part and parcel of exactly, it's right down the pipe with what we do. Sometimes I get into a little bit of hot water with people who operate in the ETF space, because my message often is you don't necessarily need to pay 100 basis points to have the exposure that you get from this ETF or that ETF. The interesting part about that is when people are looking at ETFs that have what is called, essentially referred to as defined outcome ETFs, what you need to think about when you read that in a prospectus is that these people are using options in some way, shape, or form. You can't get a defined outcome without actual optionality involved in it. And so anytime people are using options in that way, there are going to be associated costs with it. Now, the ETF packaged up as it is gives you an incredible amount of flexibility and convenience, because you can hit one button and you're done with it. Mm-hmm. However, my message is always, it's better for you to understand how the actual underlying optionality works, because if you understand that, you can go out and create these defined outcomes with options on the underlying that you're looking to trade, right? The defined outcome ETFs is really, there's two pieces to it. There's a yield vehicle and there's an option trade. And you use the actual coupon from the yield vehicle to pay for the option trade, right? That's what they're doing. It's not rocket science. Yeah. But it's important to understand that it's available for people to actually execute themselves, but you need to understand how the options work in order to do it.
And I think you just had an interesting point from a trade structuring perspective, is having that yield component and then allocate that to something else.
Absolutely.
And reduce the overall debit that you're putting out there.
Yeah. I mean, it's like I said, it's not rocket science, right? Yes. It's yield and options. That's basically all it is. And you're using one to pay for the other. So.
All right. We're done here, but one last thing. Can you share, you've been a trader for a very long time. You've been in markets, right?
Yeah.
I don't want to date you, but
okay,
you've had some defining moments and lessons. Can you share one that tops the list and how it guides how you think about structuring trades in this reflexive, fast-moving environment?
Yeah. The first one that comes to mind is probably 2015. For anyone who's traded the SPX options before, there's a function of the SPX called the roll, which is the recreation of index deltas with the actual options themselves. In 2015, around Christmas time, which is a particularly illiquid time, the roll that everyone thought was worth $7 printed $27. And it's one of those situations where when you look at it and you look at it from the side, and in my case, when I look at it in hindsight, all of the signs were pointing that direction, but no one wanted to believe that it was possible for the roll to print that far away. And the reality of the situation is that these markets can do extremely irrational things, right? What's the saying? The market can stay irrational longer than you can stay solvent. With options, it's really important, because they're leveraged vehicles, that people understand how the leverage works that operates underneath that belies these contracts, right? The math behind it. And so from my perspective, that is my constant message, which is strange things can happen in the marketplace, and when you're dealing with options, it's really important that you understand the actual optionality that exists there, because it can be a really powerful tool, but it can also be a very sticky situation if you don't understand how they work.
I love that example. Thank you so much. Round of applause, please.
Yeah. Thanks.